If you've ever tried trading NFP, I'm sure at some point you were looking at the charts and thinking to yourself, what the fuck is happening right now? NFP can create a lot of volume in the markets, and for most traders, that destroys them. But for the ones who actually understand how to read the data, that same volume from NFP actually creates opportunity. My name is Josh Paveo, and I've been trading NFP on things like gold, NASDAQ, and the US dollar for almost 6 years. And in that time, I've seen how the markets react to NFP over and over and over again, both short-term and long-term reactions. So in this video, I'm gonna share with you 3 things. The first thing I'm gonna talk about is what is NFP? And I'm gonna talk about why does it matter for the markets? How come it causes so much volume in the markets? What does it mean for the markets? And then for the third piece, I'm gonna show you a 3-step framework that I currently use every single month for trading NFP and doing my analysis when it comes out. So NFP stands for non-farm payrolls. And non-farm payrolls is just a measurement that tells us how many jobs were added or lost since last month. There's this big department in the US called the BLS, and it stands for the Bureau of Labor Statistics. And their job is basically just to collect data and then publish that data. They publish the data to things like this. This is an economic calendar. You've probably seen the free version on something like Forex Factory, but if you just search economic calendar on Google, you'll find a ton of them that come up. There's a lot of different resources for this. But BLS is basically just collecting their data and then pushing it out to these calendars for us to see. The way that the BLS gets NFP data is they send a survey to 120,000 employers. And this survey only asks them one question. How many employees were on your payroll this month? Now, it's a little more nuanced to that, but that's basically what they're asking. And by comparing their answers to last month's, they're able to give us a rough estimate of how many jobs were either gained or lost throughout the last month. That's how we actually get this NFP number. But why does any of this even matter so much? Why do the markets, gold, NAS, US 30, the US dollar, everything has such a crazy reaction from jobs data, someone getting a job? The reason that we see so much volatility and volume when NFP comes out is because the markets are very sensitive to something called interest rates. And the level of interest rates are determined by a bunch of pieces of data, NFP being one of the most important ones. And in order to understand this next part, you need to understand who controls interest rates. Now, the Federal Reserve is what we call a central bank, which is basically just a bank for a country. The biggest difference between the Federal Reserve and, say, like a regular institutional bank would be that the Federal Reserve can actually create currency. It can print new money. And if you look on the Federal Reserve's websites, you'll see that they have 2 main goals. The first one says maintain price stability, and the second one says maximum employment. Now, these 2 things can be translated into keep inflation low while keeping employment high. And this is the goal of the Federal Reserve. But when employment gets too high, inflation can also increase, so this can be a problem. And the way that the Federal Reserve tries to control inflation, or maintain it rather, is through interest rates. Interest rates impact things like mortgages, car loans, and business loans. So what happens when interest rates go higher, the way that this lowers inflation is that it essentially slows down the growth of the economy, right? When you think about mortgages, it becomes more expensive to purchase a property, right? So what happens is people stop refinancing their homes. They stop looking for new homes. They stop looking for new cars. And on the business side, it just becomes more expensive to do business. So what happens is you end up seeing a lot of people getting laid off. All of this happens from high interest rates. So the Federal Reserve basically has this kind of like balancing act between the inflation data and the labor market, and they're using interest rates as one of their main tools to control this. And the reason this is so important is because interest rates have a huge impact on the direction of the markets. So the Federal Reserve is actually monitoring NFP in order to make their decisions on interest rates, right? Remember, NFP is the labor market. So when we're talking about keeping employment high, they're making their decisions on interest rates by looking at pieces of data like NFP. Let's go over a real-world example from the chair of the Federal Reserve, Jerome Powell, in a speech that he said in November 2022.
We need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%.
When he says sufficiently restrictive, he's just talking about like we need to restrict and constrain the economy more. That's what raising interest rates means. It restricts the economy, which ends up lowering inflation.
In the labor market, demand for workers far exceeds the supply of available workers.
Everything in the world works off of supply and demand. So all he's saying is that there's too much demand for the labor market, not enough supply. This is inflationary.
Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor force, in the labor market.
The Federal Reserve likes to give us hints, which is nice because at these speeches, they tell us what are they looking for in the data, and based on when that data comes out, what are they going to do with interest rates? So the question that you want to ask yourself isn't how will NFP impact gold, NASDAQ, or NQ, or US dollar. The question is, how will NFP impact interest rates? And then, how will interest rates impact gold, NAS, or US dollar? Now, NFP, when it comes out, is not always going to raise or lower interest rates. This is why sometimes when data comes out, we get massive moves in the markets, and other times we get a lot of chop, crappy price action, and a lot of fake outs. So I'm gonna share with you my 3-step process that I use for analyzing and trading NFP every single month. And the framework that I use follows these 3 steps. Number 1, expectations. Number 2, surprise. And number 3, bigger picture. Expectations basically answers the question, what are the markets expecting? Now, sometimes you're gonna see this called forecast. Sometimes you're gonna see this called a poll. It is just what the markets are expecting for this piece of data that's coming out. You've probably seen some online before. Here's a free version from Forex Factory, right? We can see the forecast number for all of the data right here. You can see the previous, this is the actual, data's already come out now, but that is the forecast number. That's where you can see it, that's where you can find it. It just answers the question, what are the markets expecting? Now, number 2 in this process is called surprise. Because once I know the market's expectations, now I want to plan for a surprise in the markets, which is basically asking, what do I think NAS will do if NFP comes out higher? But also, what do I think NAS will do if NFP comes out lower? I don't want to predict whether or not I think NFP is going to come out higher or lower. I actually want to plan for what I think is going to happen if NFP comes out lower, and what do I think is going to happen if NFP comes out higher. Doesn't mean I'm going to take a trade every time. I just want to plan for both directions. And number 3 is bigger picture. This answers the question, if NFP does come out higher, what could this do to interest rates? Or if NFP comes out lower, what could this do to interest rates? This is super important because remember, interest rates are what move the markets long term. So for example, if you know that higher NFP means higher interest rates, and you also happen to know that higher interest rates seems to be bad for gold or NASDAQ or Dow Jones, then when NFP comes out higher, you're gonna know the direction of the markets because you know the direction of interest rates based on NFP. Now, just to be clear, higher NFP doesn't always mean higher interest rates. This is why paying attention to those speeches from the Federal Reserve, like I showed you earlier, is super important. I hope this was helpful. If you guys have any questions, if there's anything that you guys would like covered, let me know in the comments below, and I'll see you guys in the next video.